Okay, on the last go-round, the first video of this series with S corporations, we learned about the fact that there's this AAA account which tracks pluses and minuses, income pass-throughs, loss pass-throughs, and distributions. And we started getting into the fact that this affects the basis, but we didn't really define what basis means. So that's what we're going to do now. And while we're doing it, we'll understand why basis is important when it comes to the S corporation. So let's first talk about the definition of S corporation shareholder basis. Now this is the basis in the hands of the shareholder. So even though we're a business entity class, we can't help but ignore the relationship between the corporation and the shareholder. So this is shareholder basis in this case, because of the fact that it's a pass-through entity. Since the entity itself doesn't pay tax, if it was purely a business entity, of course, what I could say at this point is, okay, S corporations don't pay tax, let's go to the next topic. And where would that leave you? Well, it might not leave you with a really good understanding of how it works. So that's why we have to get into the shareholder basis, because the shareholder is the one paying the tax. So the S corporation gives the K1 to the shareholder. This we learned about. And at that point, the shareholder the shareholder follows what the K1 says to do. Either it's an income item of pass-through, or the corporation had a loss, so it's a loss pass-through, or it's something else. And as we learned in class, there's a bunch of separately stated items as well as net income or net loss. For the shareholder to be able to use the basis, for the shareholder to be able to use a loss, this is important to say this way, for the shareholder to be able to use the loss against other income that they might have on their personal return and get a tax benefit from doing that, they have to have basis. That's rule number one. So we learned also last time that if you have a loss, we don't want a loss, but if you do have a loss and you have other income on your tax return, since that loss gets combined against the other income, it reduces the other income subject to tax, or it could reduce the other income subject to tax and reduce your overall tax. So you don't want a loss in a corporation, pass through S corporation, but if you have one and you can use the loss against other income, so it softens the blow of the loss because you reduce your taxes by the amount of the loss. So rule number one to know if you can use the loss against other income is you must have basis. So this is rule one. You must have basis. So if you have to have basis, we need to learn what basis is. So here's how basis is calculated in an S corporation. For the shareholder, shareholder's basis. It's pretty easy. It's first what you put in. That's a plus. That adds to basis. What you put in. I put in $100 in. I put $100 value of land because I want to have the stock. So it's sort of section 351. And that's exactly what it is. What did you put in? You got stock back out. How much did you put in? So how much you put in adds to your basis. So it's an additional amount. By the same token, what you take out, like a restaurant, what you take out is a subtraction from basis. And that sort of makes sense, right? Take it out, it's a return of basis. It's a return of your capital. If you look at this one as the capital, which it is, this is a return of the capital. Okay? Makes sense? I think so. It should. So far, so good. So far, it should be pretty easy. This, by the way, we call a distribution. We don't call it a takeout, although I guess we could. But the proper language is it's distribution. And of course, along the way, if you put in more money, even not under Section 351, that adds to your basis as well. So later when you put more money in, it just adds to your basis. The next thing that we have to say as part of basis is if you loan money, so it's a shareholder loan, that adds to basis. It's no different than what money you put in for the stock back up here, but in this case you do it as a loan and it still adds to your basis. Okay, the formula is moving right along. Now, the basis is also increased by the income passed through to you, the shareholder. So that adds to basis. And the basis is reduced by the amount of loss passed through to you. And the result is you get your adjusted basis in the stock. Whatever it is. So you can see the formula, what you put in to get the stock, what you put in later on would qualify as well. So whatever you put in anytime, doesn't have to be Section 351. So we'll just say anytime. What you take out is a reduction of basis or a return of basis. Shareholder loan goes in and gets counted. We could have squeezed in also as a subtraction. We could have said when the loan is paid back, by the corporation to the shareholder, what should that be? You guessed it, it should be a reduction of basis, a minus. So we could have squeezed that in, but that's self-evident. So it's plus or minus the loans, depending on whether you're putting it in or taking it back, getting paid back, plus the income minus the loss, gives you the adjusted basis. Now the fact that you can see here that this is an element of money coming out, and this is a pass-through of income, and this is a pass-through of loss. These elements that take out the income and loss is what adds up to that AAA account that we spoke of last time. You can almost ignore the AAA account to do the type of calculations we want to do in this class. Let me give you an example of how this all works out. Now that you know basis, we'll do the following. We said that rule number 1, for a shareholder to be able to use a loss from an S corporation, from the pass-through, is they must have what? That's right, basis. So you'll look and you'll do the formula and you'll see what you come up with. If the loss passed through, as an example, is $50, and you do the calculation for your basis and you come up with your basis based on the formula at $100. So you get this loss, you look at your basis under rule number 1, you got plenty of room. Now you've got the ability to take that $50, put it on your 1040, and if you have other income, let's say $1,000, then the $50 pass-through reduces your taxable income to a whopping $950, but you're saving tax. That's the interesting thing about the pass-through. That's why I said this is really cool. Now let's do another example, sort of same idea. But different numbers. And this time we'll come in with a loss of 150. So we can do the same thing. We look to bases. Oops, we only have 100. So we get to take, we only have 100 of bases, and rule number 1 said you can only take losses up to your bases. So we take 100 as a loss, and 50 goes into what we call a suspended loss, and it can be used in the future if we get back to having basis. So the $50 loss here is suspended. Now, of course, the basis is 0 because using the formula, We had basis of 100. We reduce it by the amount of loss that we have that we can use, and we get to 0. Notice that the loss cannot go, the basis cannot go below 0. The basis cannot go below 0. But the $50 that's suspended, we keep account for in the AAA account, so we don't lose it. Let me say that again because that's sort of important. The AAA accounts where we take into account all the pluses and minuses, even if it goes below 0, the basis cannot go below 0 in real life, but the AAA account will account for this $50 that's suspended, so that if in the next year, let's do it this way, year 2, if in year 2 they have income of $100, well, how does that work with the formula with basis? Well, it adds to basis, so now you have basis of 100. The AAA account shows a suspended loss of 0, and we'll bring that over. I'm sorry, the AAA account would have shown a suspended loss of 50 back in this example. See? So we'll bring that over, and now this loss can get used in year 2 on the individual return, because they now have basis. And that's basically how it works. So if you need to understand this better, watch it again. We're going to pick up just a little bit more about this whole concept in the next video.